Fellow at the American Institute for Economic Research and Students for Liberty alum Ethan Yang sat down with Tom Hogan, former chief economist for the U.S. Senate Committee on Banking. It was a wide-ranging discussion. In the process, Tom debunked 5 critical myths around fiscal policy.
Yeah, that's right. Having the government control the monetary system means that, well, sometimes they're going to make mistakes.
Myth number 1, fiscal policy and monetary policy are the same thing.
So monetary policy is conducted by the United States Central Bank, the Federal Reserve, and they make all the money that we have in the United States, and they therefore manage the supply of the money. And fiscal policy is regular government spending that we would talk about when you see people debating, the people in Congress debating about what we're going to spend money on. That's fiscal policy. And so there's an important difference between those two, that fiscal policy only comes from money that we raise through taxes or by issuing bonds. And so it's really, if we want to spend money on something, if the government wants to spend money on something, they have to get that money either by taking it from taxpayers now or by issuing bonds that they'll later pay back with future taxes. So it all comes from taxes in the long run. In the short run, the spending is either financed by taxes or by issuing bonds, but it's all eventually going to be paid for by taxpayers, right? And so everything that you see debated about what should the government spend money on, that is all fiscal policy. That is all ultimately going to be paid for by taxpayers. Now, that's a lot different than monetary policy that is conducted by the Federal Reserve. They're just creating new money. They're not giving that money to the federal government to spend on things. What they're doing is putting that money into the financial system so that it can be used in the economy. And so the Federal Reserve doesn't give money to the government, and they don't finance the government specifically. What they do is they try to create the right amount of money that the economy is going to need as it grows. You know, the economy gets a little bit bigger every year, almost every year, unless we're in a recession, right? But typically the economy is growing a little bit over time, getting bigger and bigger. And so the Federal Reserve, as the central bank, tries to provide money that the economy will need as it grows, so people can have transactions and spend money and allow the economy to grow.
Myth number 2, new dollars are physically printed.
So the Federal Reserve manages the money supply both in terms of creating physical paper dollars. I mean, the dollars are actually printed by the Treasury and then shipped over to the Fed, and the Fed distributes them through the banking system into the economy. And so they manage physical dollars, but more commonly they manage bank reserves. And so, you know, the banks have some physical dollars sitting in their vaults, but most of the money at the banks is actually just electronic money that is managed by the Fed. They do that in 2 ways: by raising and lowering interest rates and by buying and selling bonds. So when they buy a bond, they'll buy it from a bank and they'll take a bond out of the economy and put money into the economy that goes into the bank. Again, mostly electronic, not physical paper dollars. They just credit the bank account of that bank. And then the other way is by raising and lowering interest rates. And what that does is the Fed isn't putting money into the economy, but it's allowing banks to create more money. So banks create money when they create loans. They'll lend money out to people, and those people will later pay it back. And when they lend that money, if the interest rate is high, then you're going to have less lending because it's more expensive for people to go out and take loans. If the interest rate is low, then more people are likely to come to their bank and want to borrow money. And so by raising and lowering interest rates, the Federal Reserve doesn't directly change the amount of money in the economy, but it influences the amount that banks create, and therefore, you know, manages the total money supply in the economy in that way. But as you mentioned, we don't have to have the government doing this. In fact, for most of U.S. history, the part about banks lending was not managed by the government. It was just done by the banks themselves about how much money they think would be needed in the economy and how much their customers were wanting to come in and borrow. And so it was really a supply and demand mechanism that was created. And the banks actually printed the money themselves, and the banks would all have individual banknotes that said what bank it's from. You know, like today it would be like Bank of America, B of A bucks, or something like that, right? That if somebody wanted to borrow money, they would get money that was actually created by the bank. And so now we have this government agency that manages the money supply, and that's sometimes a problem because they can do a good job or maybe they can do a bad job. but it's a lot different than if you had the private banks just responding to supply and demand. If you think that they're going to do that, then they're probably going to do a pretty good job because they can't print more dollars than their customers want.
Myth number 3, centralized banking solves most financial problems and doesn't create any.
Having the government in charge of the money supply can potentially create some problems. I mean, in theory, it could create some benefits if you think that the government's going to do a really good job and that the Fed's always going to provide the right amount of money. And some people think that, right? But that historically hasn't really been the case. And there are a lot of reasons why you wouldn't want the government in charge. I mean, just in terms of having one central agency making the decisions rather than everyone in the economy, that having hundreds or even thousands of banks making independent decisions. If you have lots of people making decisions, then the banks, well, sometimes they're going to create too much money and sometimes they're going to create too little, but they'll probably cancel out. You have some doing too much, some doing too little. If the Fed is doing it and you only have one agency, then if they do too much money, that affects everyone, right? Too much money in the economy means people are going to be spending and that's going to drive up prices, and so you're going to create inflation. If they have too little money in the economy, then people aren't going to be able to afford to make transactions. Stores are going to lower their prices, and you can potentially have deflation that's going to slow the economy down. And so that's a problem because, the Fed is in this situation, having one central bank. They have to perfectly get it right, and any overissuance or underissuance causes problems in the economy. There's also a problem of knowledge that they just might not know what the right amount of money is. Again, if you have different banks making different decisions, some are going to get it right, some are going to get it wrong, but they're also responding to demand from their customers, right? And so they have direct insight, they have direct information about how much they should be creating. Whereas the Fed is just looking at very broad aggregates about what's going on in the entire economy. It's very hard for them to have good information about how much money people actually want to hold. And so it's a situation not just of one agency doing it, but also a regular problem of government that the government just doesn't know and isn't as good as private businesses at responding to customer demands.
Myth number 4, the Fed acts in our best interests.
Ideally, we would like to think that the central bank is going to act in the best interests of people in the economy, but they definitely sometimes try to pursue their own goals. And sometimes they do that because they think that they're doing the right thing. So, for example, if the economy is going into recession, they maybe want to try to stimulate the economy and try to encourage people to spend more, so they issue too much money, knowing that people, when they receive that money, will feel like they're richer and will go out and spend more. But then what happens eventually is prices go up and people realize, oh my goodness, I wasn't as rich as I thought I was. If I had known that all these prices were going to go up, I would have saved some of this money rather than going out and spending that. That's what we call money illusion. When people have this illusion that they're richer, but it's really just that there's more money in the economy. And the Federal Reserve knows this. But that's what they try to do, is they try to stimulate the economy sometimes by tricking people into spending more, right? And so even in the case when they're trying to do something good, they're in some sense doing it in a malicious way that some people are going to be harmed by that in the economy. Some people will benefit, but a lot of people that would have wanted to save that money were tricked into going out and spending it. And so that's part of their actions in trying to stimulate the economy and trying to do their job. But it's also the case that sometimes they're not guided by a benevolent motivation. Sometimes they're doing things that are going to benefit themselves as the central bank, and sometimes they're doing things that are going to benefit politicians. It's certainly the case that in the United States, we have a mostly independent central bank in terms of the Fed, because as I mentioned before, they're separate from the government in terms of they create money and put it directly into the financial system. They don't send it over to the federal government to spend. In a lot of countries, that's not true. In a lot of countries, the central bank is beholden to the federal government. And so Congress or the president or the dictator can just call up the central bank and say, like, hey, we need $1 million, print it up and ship it over. That's obviously going to cause problems, right? Because they're going to push the central bank to create too much money, they're going to create inflation in their economy, and they're going to spend it on things that the dictator wants that are not necessarily good for the economy, right? And so we see that in a lot of countries. We see it especially countries in South America and in Africa. Many countries have problems that the dictators or the leaders there spend way too much money. They get the central banks to finance all that spending, and then they end up destroying their own economies. And so that's been a persistent problem in countries that don't have, strong rule of law, don't have separation of powers, and don't have independent central banks, that the politicians have been able to exploit the central bank and destroy the economy, harming the citizens of that country, but benefiting themselves personally. That's happened a little bit in the United States. There have been cases, especially in the 1960s and 70s, where it appears, and we do have evidence actually, that the chair of the Federal Reserve was acting under political pressure to try to stimulate the economy, to get the president reelected, or for some other political purpose. And so that does happen a little bit, but for the most part, the Federal Reserve is seemingly somewhat independent. It's also, in the last couple of years, kind of reverted and been beholden to political pressure, but we're a lot better than they do in a lot of other countries.
Myth number 5. The recent wave of inflation was impossible to predict.
The simple answer, to me at least, is pretty clear, that the Fed printed way too much money, and they were pushing the economy too hard. Like I said earlier, they can try to stimulate the economy by putting a bunch of money into the economy and getting people to go out and spend it. And that's what they were intentionally doing, and just did way too much. Now, there are a lot of other nuanced parts to that. In the decade from the 2008 financial crisis until COVID, it was interesting because we were actually undershooting our inflation and undershooting our growth targets, that the Fed wasn't doing enough. And even though they were doing a lot of quantitative easing, they were printing a ton of money, more than they had ever done before, but the banks were just kind of sitting on that money. They put the money into the banking system, and then the banks didn't use it to make loans and get it into the economy. And so it never ended up stimulating the economy. And so the Fed thought that's what was going to happen again after COVID. When they put a bunch of money into the economy, they thought they were not going to be doing enough. And so they kept doing more and more and more, and eventually caused a lot of inflation. Of course, they saw a lot of inflation happening at the time, and so they should have known that their policies were creating that, but they wrongly thought that it was just caused by supply chain problems, that it was caused by other problems in the economy, and not by their own actions. And so they misunderstood what was happening in the economy, and so that was part of the reason that they ended up doing too much monetary policy and ended up creating inflation. But it was also, I think, that they moved from a stance of trying to passively assist the growing economy, instead of just supporting economic growth and putting the right amount of money that was needed to grow the economy. They really tried to push it and took an active policy of really trying to stimulate, really trying to put so much money into the economy that created a lot of growth, because they wanted to push down unemployment rates. They wanted to get unemployment down to the lowest rates ever, like we had seen just before the COVID crisis. And they thought for some reason that they could push the economy and not have any negative consequences. And so partly I think it was just a mistake, and not understanding what was happening, but partly intentionally pushing the economy way too hard, beyond what they had done before, beyond passively assisting. They were trying to actively push it too much, and should have known, and at some point did know, that those actions were harming the economy, harming Americans by increasing prices.